You can support this podcast for $3 a month at patreon.com/Copytraders Club. Or find me on eToro, username Gavin Macaulay, and add me to a watch list for future content. Thanks for listening. Copytraders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin Macaulay, my name and username on eToro. Today we talk to an elite popular investor from Greece. Here we go. Season 2, Episode 11 of the Copytraders Club podcast, and as always, my aim as an eToro enthusiast is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. In chats like today's, the aim is to answer all your questions about this popular investor, and reveal more about them than anywhere else, so you can assess whether they might suit you. Today we talk to Filippos Zofakis, aka Hedge Fund, an elite popular investor whose education and career have seen him steeped in the world of finance. And here he comes. Filippos, Yassas, Kalimera, Kalosir Thesto, Copytraders Club.
Not too bad. Yeah.
Not too bad.
Good enough. It's quite basic, I guess. The first, it's like, hi, good morning, welcome. Yeah.
Okay.
Quite good.
Well, thank you for your praise, Filippos, and we're delighted to have you at Copytraders Club. As you may or may not know, you have to answer a series of quick-fire questions to get past reception. Ready for those?
Sure.
Username on eToro.
It's hedge fund with an underscore in between, so hedge_fund.
Date you joined eToro.
It was, I think, I can't remember the exact date, but like end of 2020. Yeah.
Date you became a popular investor.
A few months after that.
Year of birth.
1991.
Place of residence.
I'm in London, UK.
Profession.
Well, I've worked in finance mainly, and quantitative in particular, so quantitative finance.
Briefly state what you aim to achieve on eToro.
I think it's a good platform because of the social element. You get to interact with people and they can follow your posts and your strategy. And yeah, I was mainly doing it for myself, to be honest, but it's also nice to have a following and to get to interact with people.
Name one of your investing heroes.
Well, people usually would say, I guess, the typical ones like Warren Buffett and Benjamin Graham and those, but maybe I like to follow Michael Berry, because he's more of a bear. So he keeps deleting his tweets, but there's the other accounts that take screenshots, and then you tend to follow the trackers, on Twitter and stuff. So then you post something like sell everything, and then it's deleted like a few hours later. Yeah, so that's quite funny.
Name one of your favorite investing books.
I don't have a specific book actually, but there's plenty actually. There's interesting ones. There was the one book about Renaissance Technologies, the founder. It's like the man who beat the markets or something like that. This biography, so that would be a good read. Or read something like Black Swan, from Taleb, or and the typical value stuff. I guess the Peter Lynch, Benjamin Graham, those kind of things. Also, if someone's like a fundamental investor, you can read like the annual letters from Warren Buffett to his shareholders, that stuff, or like other fund managers that they publish like an annual report, and you can find the old ones online. So this would be good, like reads about the philosophy and stuff, I guess.
That completes the formalities. Let's proceed into our VIP section here at the clubhouse. The wonderful Copytraders Lounge awaits you. Filippos Zofakis, aka Hedge_Fund. Are you ready for this magical transition?
Born ready.
Okay, so you're from Greece, and there's a Greek name in my head at the moment because I've just watched the Glasgow Derby. Does the name Ange mean anything to you?
Not quite. I'm not a huge sports fan, unlike the rest of London, I guess.
Well, he's the manager of Celtic in Glasgow, and he's a Greek fella that emigrated when he was 5 years old to Australia, made a name for himself there as a player and now manager. And he's likely to become a household name, I think.
My good man.
Okay, so you're from the island of Crete.
Yep.
What's it like to grow up in Crete?
It's quite a small place, I guess. It's more like I guess, typical Greek island in a sense. But then I tend to joke my hometown is about the size of Clapham in London, like one neighborhood in London. But it's like on an island, so on its own, kind of remote in that sense. I mean, still like one of the bigger Greek. It's the biggest Greek island actually. Uh, but yeah, it's nice in summertime for like very touristy.
I've not been to Crete. I've been to Cyprus. Is Crete very picture postcard, white villas on the hillside running down to the crystal ocean?
Unfortunately, not. I shouldn't say, but unfortunately not, because that's more like the smaller ones. The smaller ones, like the Cycladic, islands like Mykonos, Santorini. These are like just the more like traditional that people think of. But Crete has many like beaches, probably the best beaches. So it's more like, oh, just rent a car and just drive around. Yeah.
And do you know, are you well versed in ancient history? Obviously, Crete plays a major role in Greek ancient history.
Oh, the Minoan stuff. Uh, yeah, the Minotaur, the maze. These are the inventions, I guess. Yeah.
Okay, so then you moved from Crete to go to university in Amsterdam, where you did a Bachelor of Science in International Finance, and you graduated cum laude. How was it going from Crete to the European city of Amsterdam?
Well, Amsterdam, it's got a reputation, of like kind of like a few districts there, and the city center are very touristy, and people going there for like I don't know, like I guess people from England going there for like bachelor parties or stag do's or hen do's, but it's quite calm otherwise. I think Dutch people are very, just go about their business, just go to work, home by 9 p.m. and stuff. So quite calm otherwise. That's quite. I think it's a very organized place. Like good. They've got their kind of like society and structure, so it's good to study.
And presumably you studied in English.
Yeah, they do have quite international universities, so I could speak some Dutch, But yeah, I mean, to study, it's obviously. I think nowadays, most of the academic papers and stuff are in English anyway. So.
So was your English already on point by the time you went to university?
Yeah, because growing up, I mean, I did like English classes, like for like many years, and then that was like a common thing actually. And then I used to watch, American TV series like typical ones like Friends and stuff on the telly. And then when I came to England later on, they would say like, "Oh, how do you learn English?" From just watching like American TV, and like they could tell in the beginning.
Mm-hmm.
Maybe I called like I said like the sofa or the couch instead of the sofa and that kind of stuff. So it might have been evident, but yeah, by now I don't know.
Well, the American theme continues when you went to Georgia, University of Georgia in the States for an exchange semester. So you were just there for a semester, right? In Athens.
It's funnily called Athens, Georgia. In America, they basically have like five Romes, like Rome, Florida, Rome. They have like a few Athens, like every city you can think of. They have like, they might have like something like London, Alabama, that kind of stuff. Like, so I guess they come up with a name that they like. It's good though. It's funny, but good. In over there in Georgia, it's the south. It's the south of the U.S. So uh, they have their own culture, I guess. They at that university they cared a bit more, I think, for sports, than actual. They're like, okay, you guys study, you're the best academic generation of this university and stuff, but don't forget to go to the football game on Saturday. And I mean the American football, kind of like the NFL or the college football. So they had a guy who was a banker, and then he sold his bank, and then he built them a stadium, like a massive stadium at the university, and that was a main focal point of the uni. But that was, I mean, if you're studying abroad, it's great because you're kind of like a guest, like a tourist, but like a guest, and they always like want to be like a nice host, to you. So good fun.
And Athens is, in my perception, like to Georgia what Austin is to Texas. Is that accurate? Or
Nah, Austin is like a big city, It's got a tech scene. They're doing festivals, the South by Southwest. Austin, like in Georgia, they have Atlanta. Atlanta is the big city, and they have some unis there, and then they have like college towns there. So they have towns that basically the whole purpose is to have the college and the university because it needs more space, right? So they put it outside the city, a bit further out. But for Americans, I think driving like an hour is like nothing, because they're vast, it's a vast country, right? So it's basically a college town.
well, what I know Athens for is the music scene. It's created lots of famous bands, B-52s and REM, Neutral Milk Hotel of Montreal, all came from Athens, Georgia. So I thought it was kind of a hipster scene.
And I guess it's got a big uni, so it's kind of like a uni, yeah, hipster vibe, yeah, bars and stuff, and they like live music, I think, down there, yeah.
Okay, and then rounding off your education, University College London, Masters in Computer Science, distinction in everything, Dean's List Award.
Yeah, I guess, I just study the things I liked, so uh, if you enjoy the topic, then it's kind of easier to do well. But that doesn't, I mean, um, I guess now I think you can learn everything by yourself, like now there's YouTube tutorials and you just pick up the book and stuff. But then I've already got the masters and stuff, so maybe it's just I've already gone through the process, so I know how to go about it by now. Um, so I guess it helps overall, career wise and stuff. But I'm a bit of a competitive person as well, So when you put me in that kind of like environment, I just try and compete.
Well, there's no doubting your academic background. We're going to talk later about your career professionally. But yeah, you did a Bachelor of Science in International Finance and then a Master's in Computer Science. It's pretty interesting. Okay, so I always talk to the guest about how I came across them. How did I come across you? I don't think there's any great story to this. I just think on the platform, on eToro, you just rose in prominence, I guess, over the past year, maybe 6 months.
I tend to post sometimes about like oil and macro and various stuff. So I guess it comes up on people's feeds, People comment and stuff, and then yeah.
All right, let's get to know you a little bit more then, Filippos. Do you want me to call you Filippos? I saw your name is Philip somewhere.
People typically say Philip was easier, I don't mind,
I'll
but
stick with Filippos.
yeah,
Okay, tell us something you're really bad at.
really bad at. I wouldn't say I'm bad at anything because I mean, even if you're bad at something at the moment, you can always work on it. So, for example, like, oh, I never used to cook much, because I mean, I went to unis where they had a canteen and stuff, and growing up, I mean, you had your parents cook for you, or you'd go to school or university and they have meals, and then you're just working, so you just go and eat out. grab some lunch, go back to the desk, like in London, for example, in the city of London and stuff. So I never used to cook a lot. And then that was a complaint of my ex. It's a different story. But then I did some cooking classes. So I would say, oh, I was bad at cooking. But then I just did some classes, and stuff, and then get some subscriptions that they send you like instructions and recipes and everything. So now I think I'm like a master chef, like Malaysian food, Chinese food, everything.
Very good.
So I wouldn't say it's kind of irrelevant to the investing topic, but I think the takeaway is you can think you're bad at something, but it might mean you haven't tried it. Like okay, you're not gonna become like I can say I'm bad at sports, but I'm not gonna become an Olympian. Like maybe it's too late for that. But you can be like I don't know, 80% good at that, and that's good enough. Like you don't have to go to. I think people trying to go to like 100%. But sometimes just get good enough. Result is all right.
That's a little topic we might return to later. Okay, let's have a question from the art of people. If you could pick a number between 1 and 10 that isn't 7.
I was thinking of 7. That must be the most commonly
Everyone
picked
says
one.
7. I think we should leverage that fact and make some money from it.
Like a lottery, play the national lottery or something. How about a 4?
Number 4. What is the most exciting thing in your professional life right now?
In my professional life, well, there's n- I wouldn't say there's anything like if it's something like too exciting. Exciting might be oh you have your own startup and stuff or whatever, and then you'll be like oh it's exciting. But people typically tend to like hype things up. I think it's more of a journey, right? So you just keep going, keep learning things along the way, and you never know where things end up. So you never know where things exactly will take you, I guess. I mean, maybe some people are very targeted and they only do one thing and then keep at it. But yeah, just enjoying the journey. And I think there's no point to stress or rush things because sometimes you might tend to get anxious and be like, oh, why am I not there yet? Or why am I not so successful yet? Or blah, blah, blah. But then you're already doing like well enough, I think, and then just keep going. That's the more of a. I've adopted more of a Zen approach to life lately. It's more, yeah, just enjoy yeah, the journey instead of like just stressing over things.
Okay, Filippos, let's turn our attention to your profile now on eToro and let's have a look at your bio. If you could read the first 3 paragraphs, experience and strategy, and then the blue arrows, and we'll talk about those.
Yep. So experience, it says, worked as trader, investor, strategist in London. Strategy is mainly equities, like more like capital growth, long term, um, and investing in broad like macro themes. Uh, Also incorporating the macro environment in equity investing, and it's more of a high conviction portfolio to get more growth, but kind of like diversified enough, so it's not too risky. Um, so almost like 100% invested, like maybe like 10, 20 core holdings. And occasionally there might be other positions, in like FX, commodities, depending on other opportunities that might arise. And there's no crypto because I guess it's a different story.
Okay, great. So you've been working in the city since 2019, including T. Rowe Price and Lloyd's Bank, and your entire professional career has been doing work in this area, investing related work, right?
Uh, Sort of, yes, mainly. So I'm not investing at the moment, just for myself, but I have the model portfolio and then look at it. Um, but basically, the background is in different kind of investing, but not so much equities, a little bit of equities, but more in my previous work, more around macro like economics, so like one of the fixed income side or systematic, uh, meaning there's a specific kind of investing where most people think like, oh, just buy some stocks and find the best stock and stuff. Um, but if you have big pools of money like pension funds or uh, like basically institutional investors, they want to be more diversified and they want to, those for regulatory reasons, they want to have a lot of other assets in safer, so-called like safer investments, like fixed income basically, which is like the stuff like bonds, um, whether it's sovereign government bonds, whether it's corporate, like companies issuing debt. Bonds are basically like loans that are traded publicly. Um, it's not just like a stock exchange, but yeah, it's basically like a loan. Think of it, but a loan to a government, like the British government, or a loan to a big corporate, a big company. And then there's also private loans, which are more to, it can be to companies, but also can be like smaller ones. So that investing has a lot to do about interest rates and central bank policy and the macro economy, meaning what's growth in a country, where's inflation heading to, what's the central bank going to do in response, um, because you're getting fixed payments over time. That's why the name fixed income comes. You're getting like an interest payment every 6 months or whatever, and then the value of that varies depending on the interest rate that you use to discount it to the present. Because you say, oh, you're going to get fixed interest payments over 10 years. And then obviously, if your interest rates are very high, then they get discounted to the present. That's worth a lot less than if interest is like almost zero, like it had been for the past 10 years, I guess. So that's why I guess we saw a sell-off like last year, in uh, government bonds all across the spectrum, I guess. But anyway, I was mainly focusing on the macro side and the fixed income side, and more from even there, you have different subsets. So you have people that do, I pick one company and then I look at the bonds of the company, and then I look at the balance sheet, the fundamentals of the stock. I look at how's their revenue, how is the sales growing, the profit margins, the free cash flow, and then do they cover the expected debt payments? So if they borrowed money, so most companies borrow money because it might be, the shareholder might expect, I don't know, like a high, more than 10% return on equity. But maybe they can, if it's a good quality company, they can issue, or at least perceived by the market, they can issue debt at like, I don't know, 5-6%. So then it's cheaper, or they can deduct the interest from their taxes, from their profits for tax purposes. So most companies want to have some debt ongoing, but then if the expected money they're going to bring in is not enough to cover the debt payments in the future, then there might be a problem there, right? Uh, so that's basically like the fundamental way, discretionary way of like investing in companies, where you tend to focus maybe like one sector and then analyze all the companies in it and then pick like, oh, um, my specialty might be financial, companies. And then I look at the debt of all those companies and I look at their accounting metrics, and then I tend to uh, try and predict or try and like model how it's going to go based on my assumptions. And then you see if it's a good buy or a bad one, like relatively compared to the other ones. That applies to stocks too. But then there's also the other approach, which is more systematic. It means you have more like mathematical models, and then these models help you. You put in various variables, which might also be accounting related or about the economy, depending on what you're trying to do. And then these models help you get some kind of like um, predictive idea of what's cheap, what's expensive. I wouldn't say. I mean, people try to say predict the market, but I think it makes more sense, to say like, oh, what's like undervalued, what's good value, what's too expensive compared to various metrics, and then yeah, I mean, you can't predict. I think it's too hard to predict like, oh, a month from now the stock is going to be up this much, or whatever. Like if you say like, oh, that's undervalued, that's better.
Okay, so as the listener, I'm sure can hear from your answer, while for some on eToro, myself included, investing is a kind of an interest. For you, you're deep in the nuts and bolts of financial markets. I see on your LinkedIn profile, your skill set includes working in areas like credit default swaps, collateralized debt obligations, securitization, credit derivatives, and other terms that will send the listener scrambling to Investopedia. So, do you think you know more from your professional background than you need to know to be a good investor?
There's different schools of thoughts. I don't think it depends on your. I think people tend to overcomplicate things, to be honest. But I think your needs are different if you're like just a average guy on the street versus like a very sophisticated it might sound a bit kind of like, oh, looking down on them, but like the main street doesn't really need uh as complicated things uh for as like a big investor, like a big pension fund, for example. The reason they um because there's different constraints and different objectives as well. Like imagine you're managing a big pension fund, a large pension fund, and then suddenly one quarter you have to report that you lost, like, let's say it's 2008 or 2009, and then the stock market drops like 50%. And then, I mean, even for a normal person on the street, that would be like an alarming situation, right? When they have their savings and stuff, and maybe they're planning for retirement, and suddenly they're worth half as much as before. But if it's basically like a large pension scheme where you're managing the money of like a lot of people are depending on you for their retirement, and you screw up, then basically that's like you might get fired or lose your job, or is it a scandal, or you might have to go answer to some government committees and stuff. So that's a whole different, because you're dealing with kind of like semi-public money in a sense. So that's a different. So they tend to, for those reasons, um, when you talk about hedge funds and pension funds and all these strategies or asset managers, most of the money comes essentially from pensions of people, because that's the main thing that people invest, like the main part of their savings. That they have their house, they have their mortgage, and then they have their pension savings that gets invested, and it goes to some asset managers, maybe some hedge fund, private equity, whatever. And these, so people don't tend to think, where does the money come from? Yeah, there's like five rich people, that just put money, high net worth individuals that just invest in some fancy investment vehicles strategies, but it's mainly pension money. Um, so basically that's the gist of it. Um, these people, also the regulators, if you say you lost too much money in one period, yeah, you might make it back eventually, but the regulators are not going to be happy. So then they tend to diversify more. So then starting from like, oh, I just have some debt and some bonds, and I have some equities, and that's good enough, like a 60-40, like a standard portfolio. But then they say, oh, it might be too risky. Like last year, for example, both equities and bonds sold off at the same time. That's kind of like a once in, I don't know, they say once in 200 years scenario. But anyway, that might not be diversified enough for them. So they might say, what if we put some money in private stocks, like private equity, and then we don't have to mark our books every day with the stock market going up and down. We can just mark it every quarter or wait a bit, so that smooths things out. Or it's diversified because it's kind of like a different sector of the economy, right? So it doesn't, maybe the public market moves more violently, but the private one is like some big infrastructure project or a private company that's more stable over time. So then they say, oh, what if we put in like 5-10% of our portfolio into these kind of things? And what if we buy some real estate too, and we buy some, I don't know, commodities, or so hedge funds that are supposed to hedge. So then they come up with all sorts of like different niche type of strategies to diversify their portfolio and achieve better like risk adjusted return. So basically, these are good for institutional investors, but for a normal person, they just basically need some stocks, and maybe when they're getting closer to retirement, they need some bonds. It's good enough, to get the best growth.
Okay, well, let's focus on hedge_fund, which is you on eToro, which you describe as thematic investing with a macro view and enough diversification among a relatively concentrated portfolio. So we're going to talk more about your portfolio in the next section, so we'll get into that issue then. For now, let's have a quick look at your overall results. Let me describe those to the listener. Okay, as you think you said earlier, your first month was October 2020. So you had 3 months in 2020, finished with nearly 12%. Then 2021, you finished with 41.5%. 2022, minus almost 9%. And 2023, year to date, a little over 5%. Are you happy with how it's gone on eToro in that time period?
Well, I think it's good over the period of time, but then obviously I think the issue is most people tend to follow you or, copy the model portfolio when it's basically after it's had a good run. So that's kind of like a human bias, or I mean, that's when they find out about. So then they might copy you like at the end of 2021, for example, or beginning of 2022. So then obviously they only get like the bad stretch and they don't get the good one before that. So that's a common bias in people overall. Like they might pull money out when something's doing poorly, but then put it back in after it's had a good run. I think for the only solution for that is just time, Yeah.
Yeah, buy high, sell low. And then let's have a look at your risk score. If I was to describe your risk score over the last 12 months, it's pretty much, I guess, the number 6 would jump out at me. It's sometimes 5 max 6, sometimes 6 max 6, sometimes 6 max 7. Is risk score something you keep an eye on?
Not really, but I think, I mean, it's just one metric, to be honest. It's not, I mean, you kind of know the risk of your positions anyway. So it's not like, you don't have an idea, so you need to watch the risk score. I think it's more for um, the platform to see like, oh, if you're too risky, maybe they give you like a warning and stuff. Because obviously you can't just, you might think, oh, I'll just buy Bitcoin with all the money, and then if it has a good run, you have amazing results. But obviously that's too risky for other people as well. But it's a good summary, I guess.
Yeah, the eToro risk score is its own animal. Whether it should even be called a risk score is another question, but we'll leave that for another day, I think. Let's look at copier numbers and assets under copy. Current copier numbers 908, and your copier graph, I was a little bit surprised to see, is kind of going down and to the right over the course of the last year. When I look back at your stats, your annual stats, obviously 2021, over 40%, can't be bad to that. And 2022, you're in the red for the year, but only under 9%. I guess you would explain that copier graph by what you just said about people who joined at the top and then had a year of sort of not great returns.
So people joined right after the good stretch of returns, and then obviously they see like a drawdown only for like a year. So then I think that's the nature of things, I guess, in a way, is that you might get, it depends on your strategy, but you might get like a good uh, like run of returns, and then people will start to copy you. Like you might get a lot of people like following you and stuff, and then they might have to wait. So a lot of them is going to drop off over time until you hit the next good run, and then it's basically going to jump back up. So I'm not too worried over that, but yeah.
I noticed you did a post a couple of weeks ago on this very subject saying, if I can quote you, I know a lot of people followed and copied when I had a good run around this time last year, especially towards the peak, and are still in drawdown now. However, this is not a long time in markets, and we can't expect to have big upswings if we have limited risk and keep it very safe. I prefer to run a more volatile strategy, short term, but one that's still safe from going bust because we are buying very undervalued stocks and no leverage. So we can get big gains when the market turns in our favor.
Yep. The gist of that is that it doesn't matter. Yeah, you might think that's risky or it's a risky company and stuff, but if you look at it and then it's trading like at a very, and there's always the risk of the company, something happens specific to a company and then it goes bust or whatever, or some regulatory thing or whatever. But like, let's say it's trading very cheaply, like it might be earning like 30% free cash flow and then, like annualized. And then it's going to, you know, even if the market drops and there's like a 2020 or 2008 style recession, or like can always go down even more, but then eventually it's so cheap, right? It's not going to go under, like, because these are proper companies that actually have a business, like they're actually producing stuff. It's not like you're trading. I don't pick any unprofitable tech or SPACs or any like crypto that doesn't have any earnings. They all have earnings. They're all digging some stuff out of the ground, like producing it, selling some product. So I mean, yeah, they're gonna have some demand for the foreseeable future. So and then if you're not levering up, if you don't borrow to invest, then you're not actually going to have to close the positions unless you choose to close them. So that it means you can just hold it long enough and you will get your money back. You're not gonna go bust or anything. Yeah.
Okay, one of the subjects I sometimes discuss is the issue of PIs adding funds. And I saw you had a note saying, I'm just distributing new funds proportionally among my current positions. So you're adding funds, but you're doing so proportionally so it doesn't affect copiers. How regularly do you do that?
Actually, not because there were issues, but people basically um, they might miss some position or the thinking might not be aligned and stuff. So then it's just simpler to just if you have some chunk in there, to just keep it there. But I think for popular PIs, basically the platform says you have to have some kind of your own funds as well. You can't just be like you just taking risks, without having any skin in the game, so to speak. But then it's just too complicated with syncing. But I think for most people, if someone is copying you, then I think the best strategy is to just put money every month, like average, like a dollar cost averaging type of. That's just overall whatever kind of investing they're doing. Yeah.
Okay, trades per week and average holding time. Let's see what these stats say. Trades per week, 7. Average holding time, 2 months. Does that reveal anything in particular?
I don't tend to pay too much attention to these, to be honest. Um, I guess it's more of a shorter term, I would call it, or not even like medium term, but then it's typically like, I mean, you have a theme, right? So maybe the theme is energy. And then I might pick different companies within energy. So, okay, you have more turnover, I guess, with like a transaction cost or whatever, but that's not like excessive. That doesn't matter too much. So it's just rotating between these positions. It's not actually um, like doing like day trading or anything like that.
Sure. Okay, and in terms of communication, your communication is on eToro chiefly. You're a frequent poster, at least a couple of posts a week, would you say? Is that what you aim for?
Yeah, I mean, it's mainly, well, there's always some posting guidelines because the idea of the platform is a social kind of network around investing. So you have to keep people updated on what's happening if they're following you, right? Um, but then I typically read something because I read the financial news like every day, basically, out of my personal interest or for work, but mainly for personal interest nowadays. So I just find something interesting and there's some news and I just post about it and my thoughts. So I guess it's like a Twitter kind of. I don't use any other platforms at the moment, but it's always like a time constraint. But yeah, it's just good fun.
Yeah, you're on Twitter though, aren't you?
But not actively. I just follow people to read. Mainly I don't post. At some point, I might start posting more. Yeah.
Have you made any videos or anything for your copiers, like copier update videos? Is that part of your plan?
Not yet, but at some point I might. I know some people are doing. People who have more followers and copiers, they do like a quarterly kind of update for them, like a Zoom call or something. I haven't been asked to do one yet, so not as popular, I guess, for a popular investor. But
Speaking of which, what was the peak number of copiers you had before the numbers tailed
about
down?
2,000.
2,000. Okay.
Yes, I think people tend to copy with like maybe like a grand or a bit less. So if that's from my experience at least, I don't know. There's always the outliers. But let's say somebody has like 1,000 copiers, you can equate it to about like 1 million, or a bit less, roughly. So that's I mean, over time, I guess if they stay with, then they might grow over time. But yeah, that's the initial amount I've figured out. Yep. So at the peak, when a lot of people, basically in 2022, after the good run of results in the model portfolio, a lot of people started copying, and then it got up to 2,000 people or so. But then over time, I guess, with the drawdown, it's gone down to like half of that. But I think with my strategy, you just have to, sometimes you have to wait for the position to play out. You need some kind of catalyst in the market. If you're buying undervalued stocks, you need for the market to realize that, hey, the true value is higher. So then eventually it will bounce back up. So then it's just a long-term game anyway.
Do you copy?
Do you copy?
Do you copy?
Do you copy? Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Turning to your portfolio now, Filippos, let me give a broad brush description of your portfolio to the listener. Asset class allocation: stocks 45%, ETFs 30%, indices 25%, roughly speaking. You have a zero cash position at the moment, so you're 100% invested. I think you mentioned that that's usually the case. You're usually heavily invested. You may have a small cash allocation.
Well, it would normally be 100% stocks, or almost like 90 to 100%. But the thing is, at the moment, there's all the worries in the economy and the markets. Is that since the start of the year, we had a massive run in like tech stocks and like big tech, and we had like Tesla is up, I don't know how much, 60% or something this year. Basically, it doesn't feel like we were supposed to be in a bear market. We're supposed to have a recession coming up, and it doesn't feel like that, in the market. So there's a bit of a disconnect. So because of that worry, yes, it looks like 100% invested, but it's not actually, because there's some short positions and there's a volatility position, the VIX. So these are meant to be sort of protecting. If the market goes down, I will cash them out, and then they will make profits to cover up, to not lose money when the market goes down, basically. Yeah.
Almost like a hedge fund.
Almost. So people used to say like, "Oh, you're 100% invested. There's no hedging. But yet now I guess it comes in. To be honest, if the market just keeps going up and we're wrong about this, and everyone is like wrong about like, recession, bear market, whatever, then yeah, it's just like, you made less return than you could have. But what if it goes down like another 20%, 30%? Yeah. So it's more about playing defense at the moment, I guess.
Okay, let's look at the issue of desynchronization. there's not much desync between your invested column and your value column. From what I can see, the biggest is in your two largest positions.
These are relatively new, positions. That's fine.
Your largest position is GDX, the gold miners ETF, which is 30%, over 30% in the invested column and about 35% in the value column. As a PI, are you not restricted to a maximum position size of 20% in any one asset?
That's an ETF though, so it's got a bunch of underlying positions in it, a bunch of underlying stocks. So I think it's more about individual instruments because there's quite a broad one in itself. Then it's fine. It doesn't move. You can see the risk score is actually down now. It's actually I have a lower risk score at the moment.
Mm-hmm.
Okay, it's like a 5 now, but it went down to like 4.
Yeah, that's a restriction I've only ever heard of. I've never seen it written anywhere. Have you? About maximum position size?
I think they had it, but now they just monitor the risk score. So
Okay.
if it goes above 7, if it goes to 8 or something, then it's too much,
Okay, so let's discuss some positions in your portfolio. It consists of 10 positions. As we just mentioned, GDX, the gold miners ETF, is about 30%. And then there's VIX futures, about 16%. So that's almost half of your portfolio there in 2 positions. And in fact, the VIX trade is ×2 leverage, is it not?
Yep. That basically, the idea is basically that it sounds very concentrated, right, and very risky, but actually, the VIX trade is going to move opposite to the market, right? So in effect, they're basically like, if you have 30% in stocks and 30% in the VIX, they kind of like cancel each other out. Not completely, but for the most part. There's this effect where if the market goes down, the VIX spikes, it's by design, it's how it's like built, the instrument. It means like when people are fearful and they sell everything, then there's more volatility in the market. So that's what the VIX is trying to capture in a sense. So if we're losing money from the 30% in stocks, then the VIX will be going up, and that will hedge the portfolio, that will protect the portfolio.
And is that a shorter term trade?
These are completely tactical trades. I think longer term, there's issues around like maybe there's some costs, so that's like shorter term tactical positions. Yeah.
Okay, and then the rest of your portfolio runs approximately from 10% positions down to approximately 5% positions. And I will list those for the listener because they are quite few in number. Suncor Energy, Lincoln National Corp, Synovus Energy, Toronto Dominion Bank, Northern Oil and Gas, Civitas Resources, Cosmos Energy, and Permian Resources Energy. So your portfolio is oilier than a sardine having a Thai massage.
Well, I think I'm all for the transition, could carbon neutral and all that. But then in the short term, I don't think the approach is to divest out of everything. It's just to invest and then push the companies to be more environmentally friendly because if people just sell everything, they're just going to go private and do even worse stuff, right? So that's a topic for a different conversation though. But it's basically an energy portfolio at the moment because that ties into the theme. So I got the idea of the energy, like kind of like supply demand imbalance. So that was around the time when, like Russia invaded Ukraine. So obviously I had some energy positions then, and then they spiked a lot, so that gave a big boost at that time. But it's been quite volatile since then, right? So since then the energy price have gone down and the oil price and stuff. So these companies are obviously related to like the price of oil, the price of gas, maybe. But the main idea is you come up with a main theme that's going to happen, or the main investment idea or trend in the economy, and then you try and structure your positions around that. So my idea was that the price is going to go higher because there's a lot of there's not much, new investment in supply. And then there were a lot of disruptions around Russia, for example. So we'll get to that. There's been some more developments since then. But overall, like the longer term, and the dollar is getting like devalued. There's inflation and stuff. So everything, these natural resources are going to get more expensive, like all of them. So that was the idea, to capitalize on that. But it's been a bit of a rocky year, I guess, because what happened was Russia did have curtailed supply, but then they found ways to ship it to India or China. And then China was not reopening as fast. China had the COVID zero. China is like the biggest consumer of oil, I think, like worldwide. So they had basically keeping a lead on demand because of the COVID zero policies. And now they've reopened and it's starting to rev back up, but it hasn't, like, I guess, fully yet, even though it's been like more than a year since, the whole Russia-Ukraine story started. So the supply of Russian oil has been diverted, but it hasn't stopped. So that's one part of the reason why the prices were kind of lower. And there's other reasons like speculation, like hedge funds selling out. As we saw now, the Saudis were not happy, so they're starting to do some cuts over there as well. But anyway, the thing is that the market's tipped to fall into like a supply deficit in the second half of the year. So I'm just waiting out for that, to be honest. I was waiting out for that from like last year, waiting for China to come back online, to start consuming more resources. And then that took longer, and Russia kept going. So that's been delayed. But now we're seeing like more cuts, supply cuts from OPEC and Russia as well. We'll see how much of that they actually materializes, and then we wait until the second half of the year for the positions to play out in that sense. So it's quite concentrated.
It is concentrated, your portfolio, and it's like there are three bets going on. If I look at a snapshot of your portfolio at the moment, oil, gold, and VIX, they account for the vast majority of your portfolio. So harking back to what we discussed earlier, thematic investing with a macro view and with enough diversification. Is that enough?
I think overall it's not enough for like a whole portfolio, but I think most people anyway would just allocate a small percentage to your account, and they have other stuff in their books. And then, because I'm quite confident that these positions are actually, they can keep going lower, but they're quite cheap, if you hold them for a few years, like they're very undervalued. So they will actually make money, right? Even if the market doesn't realize it, they will produce enough free cash flow to start doing like buybacks and dividends. So you will get your value if you hold them for 2-3 years. So there's no worry that, hey, you're going to lose a lot of money in the long run. So basically, you want to maximize your return. I think most of the people on the platform, they want to maximize their return. It's not like they're investing their pension money. They want like a high return on investment, and they're happy to accept some risk for it. I mean, you see people trading cryptos, like worthless cryptos, SPACs, buying like Shiba, like Dogecoin. Like, I'm not investing in any of that. I'm not putting any of that in the model portfolio. Nothing. It's all companies that actually have real cash flow coming in. So I'm not too worried compared to other people, and it's not diversified at the moment, but that's because I was debating whether to keep things in cash, because I think we've seen the mini panic with the Silicon Valley Bank, the financial is kind of like and that's kind of like been stopped for now, calmed down for now. But then you never know, the earnings are coming up. Like I think second quarter earnings, or is it like first quarter? Yeah, the earnings are coming up. And then any mini tremor or trigger or something like, can come up and then just cause the market to sell off, like, rapidly. Because I think the market's very jittery, right? And I think overall, like the stock markets are, especially like North American ones and stuff, they're quite overvalued still. You see bonds, or you can just buy some kind of like let's call it risk-free, government bond that is going to pay like 5%, or even like a 2-year or 4 or 5%. So why would you even buy stocks? The earnings yield is not as high, the dividend yield, or they don't have high enough earnings yield to compensate. So just it has to reprice in that sense. So I think stocks have to sell off a little bit more, and then maybe like 10, 20%, another leg down, and then it's going to go back up. That's my personal view at the moment. So based on that, I'm investing defensively. I bought like the VIX, to hedge. I've bought, I thought, okay, should I just keep it in cash then? And then if it sells off, you can buy. But why not have something that's going to profit when it goes down, and then I can buy still,
Mm-hmm. And what would you be looking to buy to capture that moment before the subsequent rise?
Well, that's always a bad timing. Timing is very hard, I think. Like, if people tell you they can time things perfectly, they're probably like lying or overselling. They're not. I just think, but if you see the market dropping like 5% in a day or 3, 4%, and then the next day, and then like 3, 4 days of heavy selling, then okay, you might be like, if it drops 10, 20%, like it might be time to just, average in, as they say, like buy some and then like buy some more if it goes down even further. So you're not going to be perfect around the timing. It's not 100%, but you're going to do better overall in the long run than just buy and hold in that sense, hopefully.
Would you be looking to build into the positions you currently have in your portfolio? Or do you have a plan for entering into other
yeah.
areas of the market?
If I thought there was other area that was better, I would just do it now. I'd just put money in it now, So probably just buy the similar ones, just be even less diversified overall. But if the market drops another 20%, then we don't care about being diversified. We just care about like, it's dropped so much, it's not going to go to zero, right? It's the actual economy and stuff. It's going to rebound. So then you want to be all in, kind of like, just put and then just benefit from the rebound. The gold is a different story, the gold position. I guess we'll get into that now. It's basically, you see every time something happens, the central banks just rush, to print more money to basically calm the markets and stop the panic, which is a good thing overall. But then they're kind of like overdoing it. Hence we're getting a lot of high inflation. It's sticky inflation. It's not transitory. There's other reasons like supply chains and geopolitics and stuff, globalization and reversing it and all that. But basically, they're just printing too much money. And then you want to have some hard assets. So then I was thinking, like, just buy some gold. But gold also doesn't produce anything in itself, So it's more of a tactical or a small allocation. But if you have some gold miners, okay, they're kind of like a levered bet on gold in a sense. Or like if gold prices go up, they'll have a lot higher earnings. I mean, gold, everyone knows about gold, right? Like a safe haven asset, like a hedge, like a protect against devaluation, debasement of money. That was the first kind of form of money in a sense, for thousands of years. So when they're printing money in the dollar, it's gonna come to a standstill at some point. It's gonna come to like the U.S. debt. I think it's 120% of GDP. Like everywhere across the world, like there's unfunded pension liabilities and insurance and national, all these like social security, all this stuff. We have China, Russia, all these countries forming their own bloc, which they're looking to do more trade among themselves. And then we have the US and kind of like the Ray Dalio kind of stuff, like a declining empire. So it's still just after the peak, I think, but then it's kind of like declining. And we have ascendant powers trying to fight against it. So basically, there's a lot of dangers long term. So it's good to have some gold, especially when the market starts acting up and the Fed is going to start printing again. They're going to lower the interest rates. They might not do it this year, but there's a chance towards the end of the year or by autumn, winter, they might start lowering rates again. That's what the market's pricing in now, right? And then that means like more printing money, essentially, like money losing value even further. The dollar, the pound, everything, the euro. So we want to have some gold that's actually, it's not getting printed that easily. they have to dig it out. They can't just put some numbers in a computer, right? I'm sounding like a gold bug, like those people just like move to Panama and just buy Bitcoin and gold.
Okay, well, let's shift away from your portfolio then for a second and talk about copiers. Filippos, who should copy you?
Well, I think people, if they're copying only for like a day or a week or a month, that's not going to be enough, right? So I think if they think like, oh, I have some allocation and it's going to generate some return, but then give it like a year or two at least, like ideally like longer. And they don't mind like, oh, it goes down like 20% in the interim, like it's going to rebound, So also, if some people might have unrealistic expectation, like they expect because they saw Bitcoin go up 300% in 1 year, then some people just bought a lot of Bitcoin and then the stats, look crazy. But that's not a realistic thing, I think it's a long-term game overall. So even with no copiers, no followers, just keep doing it, for your long-term building wealth, the process. So that's it. I mean, if people want to come along for the journey and the ride, and I think I'm quite confident that in like a year or 2 years or 3 years, it's going to compound over time and just generate returns. So I'm not too worried about that. I mean, I think if you're buying things that companies or assets that have actual intrinsic value and they're generating cash and the prospects like, yes, sometimes companies can go out of business because the technology changes or whatever. But if you're sort of diversified and they're actually producing revenues and earnings, profits, then you shouldn't be too worried, right? Even if the market doesn't realize immediately, it will eventually price them properly.
Okay, here's another question that you kind of referenced earlier when we were talking about the level of diversification in your portfolio. And you were saying that people should copy a number of people. So no one PI portfolio needs to be entirely diversified for the copier. So if you could describe perhaps the ideal copier portfolio, which includes you in it, what's your role in that and what should they copy around you?
That's a tough question because I think most copiers tend to focus on just like stocks mainly. I think most of them are stock based, stock investors with different kind of like some are growth, some are value. There's some people I've seen, like very few people that do like things like shorter term, like FX, and somehow they just generate some very tiny, like 0 point something percent return every month, which is obviously that's going to be very uncorrelated to the stock market. So that's kind of like they want to have. I think these things are not going to blow your brains out with the returns, but it's quite diversified, I guess. I wouldn't advise. I mean, I don't know if people want to have some exposure to like tech and growth and this kind of like companies. I think they've done like so well over the past 10 years because of like low interest rates. So I think we're in a different market regime. So if you took me back to 2017, 2017, 2018, 2019, I would just be buying maybe like more tech stocks. So it's not like, oh, I hate them or anything. But I think it's just a different environment we're in at the moment, because interest rates are like 5%, 4 5%. So you have to play in the environment you're given, you're in. But I think if people want to have some tech exposure, maybe they should follow someone else, for alongside me for that kind of like growth exposure, because I'm not focusing on growth at the moment, just value stocks. Yeah, I don't know. I think that's basically, it just comes down to diversification and stuff. So, I mean, I'm not diversified personally, so I'm not too worried myself, So then, if they say we'll put all the money in you, I'm like, okay, it's going to do well, Long term, it's going to do well. You're not going to have any problems. So it's just if they see like 1 month, might be you have a lot of oil stocks, and then the oil price goes down 1 month, and then obviously these stocks are like going to sell off even more than the oil price itself potentially, right? Like a higher beta or like more. So then they might see 1 month you're down like 15%. They might just start panicking. Like there's no need to panic. It's just If they get too panicky, then I would say either don't look at it every day. I look at it every day, so you don't have to. Don't look at it every day, or just put like 1% there and then have other stuff in it that's just gonna move in different ways. But that comes with a caveat: is that like, oh, if the whole market sells off, like, yeah, you can have some bonds, but you can have sometimes they might all sell off together, right? So the correlations, like you might think it's like moves in different ways, so you're protected and diversified. But if people panic, they just sell out of everything. So I don't know, maybe people want to have some money market funds, some bonds, but yeah, it's not perfect.
Okay, here's a question that might sound a little bit rude, but it's obviously not intended to be. Filippos, what makes you so special?
Well, we don't want to be too arrogant and say we're special, but I think it just depends on your experience. I think I have a good experience and knowledge, around financial markets, and then that's the one leg, and the other part of it is it's something you're interested in. If I were passionate about, I don't know, gardening, then I'd have a gardening YouTube channel. I just enjoy the actual process of being a investor, looking at the markets. So I think if you put the work in and you're passionate about it, other people maybe they're interested, but they don't know where to start, or they might not have as much knowledge about things, or maybe they have their own ideas. You might have your own stocks, but then you want to also follow some other strategy as well to get the benefit of that too on the side. So that's perfectly valid. So I think the strategy is a winning one because it depends also like your personal savings and stuff. I don't plan to lose money overall. I plan to, the plan is to like build wealth over time and be financially independent. So I think that resonates with a lot of people, and then it's not going to be overnight, but like 5, 10 years, even 20 years, you just keep reinvesting and compounding, and you get there. So I think if people want to join me for the journey, that's all the better.
Very good. What other PI would you say you know best on a personal level?
I think there's a few in London, but I don't interact frequently with any of them. You know what? They had a conference for like PIs and the kind of like people that have a lot of money on the platform, but mainly for PIs back in London like last year. So that was a good opportunity to meet people. And we're chatting with a few. And then I think this year they might do one in Abu Dhabi, they said possibly, but it's not confirmed yet. But that's just for PIs to learn, like an educational conference, and then meet each other and stuff. And like Yoni, the CEO, and then our account managers. So that's good fun, you get to meet people. Yeah.
So who did you hang out with on the South Bank?
There were a few, to be honest. Like I haven't kept in touch with them as much as I should have, so can't remember like too many names per se. But then I've spoken with there's one called Jordan de Boer. Jordan.
Oh, sure. Yeah.
So he was saying like they might do one in Abu Dhabi. So he was in contact. He's a Dutch popular investor. He's done quite well actually because he was shorting the market, I think, overall. But then he was saying there might be one in Abu Dhabi, so this year. So we'll meet them there.
Are there any other Greek PIs? Is eToro in Greece?
Yes, there are a few, but I haven't met them. But I've seen them in some calls and stuff, some webinars, and I think there's a few. Yeah.
Okay. Final question, Filippos. What's the one question during this chat that you wish I had asked you, but I haven't?
I didn't think of it too much because it's just you ask me something and then I keep going, and then you're like, okay, let's move to the next one. So I didn't. It's not. I don't think I've missed anything, but it's obviously quite. It's more. I guess it's more eToro focused. It's not general strategy or markets, but I do enjoy talking about like overall, different type of strategies and markets and yeah. But that's more around the actual popular investor experience, which is fair enough. Well, the main takeaway is I think we're in a time of like high inflation, and people need to keep their money, their assets invested in one way or another, whether it's in their home, whether it's in stocks or any kind of financial instrument to build wealth over time. So then, coming on from that, I think eToro is a good platform to because you get to socialize with people. Read what online, but you read what they're posting and you get to learn maybe a bit. And so it's got that nice like social element, and you can also follow people to maybe take advantage of their experience or a different approach to your own. So that's good if people want to follow and be along for the journey, or even just interact and message, and comment. Yeah.
Okay, Filippos, well, it's been very interesting interacting with you today. And we look forward to seeing how you get on in 2023, see how that plays out and beyond. See if your copier graph can take a turn upwards. You get back into the multiple thousands. Thank you very much for being with us here at Copytraders Club.
Well, thanks for having me. Pleasure.
Many thanks to Filippos for dropping by the clubhouse today. I have the feeling that Filippos' portfolio has the potential to do very well if the right circumstances come to pass, in which case he'll be flavour of the month once more with Copiers. Time, as we always conclude, will tell. That's all from me. See you on Discord and Facebook, although I'm never on Facebook and have to stop saying that. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit chat. We don't know your individual circumstances, etc., and so forth.